Hello my fellow investors and welcome back to another stock analysis of video. Today let's take a look at one of your recommendations one more time, and today we're going to be looking at the company Path. Now this one was brought up by Gigi Bajo, I think that's how you say your last name, and yeah, you pretty much recommended the company Path, which is this one that I have right here. Now this one's actually looking really interesting. We're going to take a look at obviously what they do because I have no idea what they do. Let's take a look at a quick summary of their earnings and then their fundamentals, which unfortunately, well, we don't really have a lot of, but we can still make some assessment as to where we think they're going in the future. And because of that, we really can't use this kind of free cash flow. However, we can use book value to make a determination of whether or not at the current share price this is looking like a buy. So with that said, let's get started with this analysis. Now, before we go on with anything, I actually like to take a look at the gallery of customer achievements. So they pretty much just give us all of their customers. So we got over here Uber as one of the customers. We got over here Generali. I've never really heard of them, but they are a financial and insurance company. We got Xerox. I've heard of Xerox before. We got Takeda. Now I don't know what this one is. Apparently it's healthcare. We got Applied Materials, which I've heard of before. I've actually done Applied Materials on the channel before. Dentsu, which is marketing and advertisement. Never heard of this one, but it is in Tokyo, so that kind of makes sense, seeing that they do operate in Tokyo as well as in the United States and one other country, and NYPCC. Now let's actually take a look at what they actually do. So right here we got the company profile. We got UiPath Inc. provides an end-to-end automation platform that offers a range of robotic processes automation, RPA, okay, solution primarily in the United States, Romania, and Japan. That explains the Dentsu company. The company offers a suite of interrelated software to build, manage, run, engage, measure, and govern automation with the organization. Its platform combines artificial intelligence with desktop recording, back-end mining of both human activity and system logs, and intuitive visualization tools which enables users to discover, analyze, and identify processes to automate in a centralized portal. Offers low-code development environments that allows users in the organization to create attended and unattended automations without any prior knowledge of coding. So they pretty much just like simplify the whole concept of automation really simply, similar as to how like right now it's actually really easy to make a website, just because a bunch of companies make it so easy to make a website, whereas like just 20 years ago it was nearly impossible. Well, it wasn't possible, but like you really needed to be like really smart about it. They do kind of that thing where they simplify the automation process for other companies. So with that said, let's actually take a look at their earnings summary. Now, I'm not going to take a look at their earnings per se, but we can take a look at the summary. Now, we got over here, guys, EPS normalized actual 5 cents, which was a beat by 6 cents. EPS gap actual negative 10 cents, beat by 6 cents. Revenue actual $262.74 million, which was a beat by $6.81 million. And now coming into the calculator, we got the ticker symbol for PATH, Path, market cap of $8.6 billion, a PE of NA. And no, this is not Google Finance messing up. The PE is NA is because, well, their net income is in the negatives by a lot. So that's the reason why this is an A. The current share price, it is $15.54. On the 1 year, guys, this is down 57.51%. Year to date, it is up 26.44%. However, I would like to point out something really important. According to Seeking Alpha, if we take a look at the 5-year ago graph, guys, well, they essentially came on the market, at least they went public on April 21st, 2021. And you can see that ever since then, even though we are up on the year to date 26.44%, guys, on the 5-year, this is just collapsing. In fact, looking at this 52-week range, their lowest point was $10.44. And in fact, if we take a look at when exactly this occurred at around like November 3rd, just last year, 2022. So not even 6 months ago, as if I'm recording this video. So it just goes to show, guys, that like, even though this is still up a significant amount year to date, they still are significantly down overall. And of course, the 52-week high is $37.58. They do not pay out a dividend, which does make sense. This is a pretty small company and it is a startup company. So be prepared for not having any dividends, as well as a massive issuing of shares, because that's usually what these companies do. And if we actually take a look at over here at the 5-year average free cash flow, kind of a sneak peek, and their last year's free cash flow, we can see that they're in the negatives, and it's unfortunate, but their last year's free cash flow, it is way lower than that of their 5-year average, which is again really, really bad. And now we come into the fundamentals. Now, before we do anything, guys, the first thing I have to mention is that we do not have enough information for this company to make a determination on discounted free cash flow. It is what it is. So you can see we're missing 1 year. Okay. Unfortunately, I need at least, guys, like 5 years minimum. I need at least 5 years to make a determination using discounted free cash flow. So I put this as 0, but you know, you can see right here, like I can't even tell you by how much this increased because I don't even know what this is, and you can't divide by 0, so it is what it is. Nonetheless, though, we can still make a determination based on like what I think of their fundamentals. So we got here the net income 4 years ago of negative $520 million to 1 year ago of negative $363.8 million. We can see that they are up, or at least are going up on the 4 year. I was about to say the 5 year, on the 4 year. But you can see something very, very interesting in that 3 years ago, which was again COVID. Well, they're up to negative $92.4 million. So you can see that this net income shot up massively and then they came back down. This is a trend in pretty much all the metrics. So what this is telling me is that their services were very much used during COVID. It was really high demand, which explains this massive rise. But even then, guys, this is still in the negative. Even though it is increasing, I'm going to go with like at around a 40%. Looking at the free cash flow, once again, very, very similar to that of the net income. 4 years ago to negative $375.1 million to 1 year ago of negative $134.8 million. There's an average, guys, of negative $109.32 million. However, unlike the net income, which we see over here, the 2 year ago in the net income is lower than the 1 year ago. However, here the 2 year ago is actually higher. So they have been coming down ever since their peak 3 years ago, which was the only time where they were ever positive at 3 years ago, $27.2 million. Again, that's the trend that we're going to see, that 3 years ago during COVID, they did really, really good. So for this reason, guys, I have to give this like a 15%, I would say. Yeah, I mean, you know, one time, at least they were positive one time. I'll give them that, but they, you know, from this 3 year ago value to 1 year ago, it is consistently decreasing. So yeah, 15%. Looking at the revenue, this one's looking absolutely gorgeous. We got over here 4 years ago to $336.2 million to 1 year ago $1.04 billion. Now, the reason why I'm saying this looking really, really good is because take a look at this. This graph is like consistently increasing. There are no massive outliers pretty much anywhere. So, you know, I wish that we had 1 more year, but I'm going to assume that they'll continue to increase this revenue into the future. So I'm going to say a 100% for this one. This is actually looking really, really good. Looking at the total assets minus the total liabilities, I got to give them credit. You know, they have been in the positive in the past 5 years, which is again, really, really solid. We do see a pretty big jump though from 3 to 2 years ago, going from $418.3 million to almost $2 billion, and a slight dip from 2 years ago to 1 year ago. But I kind of see this as like the same thing as like this over here, right? From like the net income, negative $92.4 million to negative $525 million, something along those lines, right? Just a tiny dip. Nonetheless, it's still looking really good overall. Average total assets, it is $1.8 billion. Average liabilities, well, it doesn't even get to $1 billion. It's only $542.76 million. This difference is $1.3 billion. You know what? If it wasn't for the outlier, this would get a really, really good grade. But, you know, at least they've been the positive. That outlier though, I mean, not outlier, sorry, that spike is just really, really killing me. So I'm not going to give them like the bare minimum. I'm gonna go with around like a 60%, I would say. Now, looking at the cash flow minus liabilities, not surprising that the 1 year where they were in the positive free cash flow, this difference went up massively. Still in the negative though, to negative $421 million 3 years ago. They missed it by 1 with a 420. Dang it, they missed it. Sucks. Nonetheless though, you can see that, well, they have been going down. It's again probably because their cash flow has been going down. So I can't really fault them because it's not the fact. I don't believe that they're taking on liabilities. How about that? I do not believe that they're taking on liabilities. And in fact, this is even proven right here. $311.3 million in liabilities to only $652 million in the span of around 4 years or so. So yeah, that's not really a lot. I mean, don't get me wrong, they doubled it, but in comparison to like the assets, that's not a lot at all. So the reason why this cash flow minus liabilities is coming down this hard is because of the fact that their cash flow is also coming down a lot, right? So not really gonna blame their liabilities for that, just mainly their cash flow. Average cash flow minus the average total liabilities, we get negative $521.7 million. Man, this is really difficult. I'm gonna go with like a 35%, mainly because, you know, their lowest point was 1 year ago, but they had one instance where they went up from negative 686 million to negative 421 million. So 35%, I would say. Now, looking at the shares outstanding, this is not a surprise that this is a massive dilution of shares on the 5-year, or at least on the 4-year, sorry. Again, this is a pretty new company. They're issuing shares, they want to grow, not surprising in the slightest, but at the end of the day, share dilution is share dilution, and they didn't do it for an acquisition. They're mainly just doing it because, well, they probably need capital one way or another, and the best way to make capital without having to impact their cash flows, which, let's face it, their cash flow is already in the gutter, is to issue shares. So we do see a pretty big, actually, we see a massive spike from 3 years ago, 185.8 million shares to 541.2 million shares. Guys, that's really bad. That's really bad. And on top of that, look at this. From 4 to 3 years ago, that's another increase. 157.6 million to 185.8 million. And even from 2 to 1 year ago, they issued a little bit as well, going from 541.2 million to 552.4 million. Yeah, they're issuing shares, not surprising in the slightest. They might continue to issue shares in the future. I mean, even looking at the previous to the current year, that is a increase of 2%. So I have to give this like a 0%. And now when it comes to the cash and equivalents, they currently hold $1.45 billion with an average of $952.5 million. Now looking at the overall grades, this is actually fairly surprising. I was expecting a lot lower. I believe Dell got a lot lower than this company, and Dell is a well-established company, right? This one, I'm not saying that this isn't well-established. I'm just saying in comparison to like Dell, which is like several years older than this one, right? We gave the net income, guys, to 40%, free cash flow 15%, revenue 100%, assets minus liabilities 60%, cash flow minus liabilities 35%, shares outstanding up 0%. Overall grade of 41 is actually not bad for this type of company. I'm looking at this, I'm like, I was expecting like, I don't know, 10, 20%. 41, honestly, it's not bad. The biggest issue here is, well, the net income and the cash flow and the shares outstanding. Once you fix that cash flow, this cash flow minus liabilities will be fixed. So that takes care of that one. But I think that they're going to continue to issue shares in the next several years. Since, again, they are a growing company. They're mainly oriented towards growth. That is definitely going to be a negative, a con to you as an investor, because you're going to get diluted nonstop. So now let's actually make some evaluation as to what the price of this company should be. Now, because we're missing a data point, well, we really can't use discounted free cash flow. So the best method that we could actually use instead of that would be the book value per share. This could be found in Seeking Alpha. It really isn't that difficult. It's in the balance sheet. You scroll all the way down where you find the shares outstanding. It's just a couple lines under that one. And then the tangible book value, the same exact thing, just a couple lines under the book value per share. And this tells us what the company should be worth based on their assets minus the liabilities divided by the current shares outstanding. And you can see, well, guys, they should be worth $3.37 according to the book value. According to the tangible book value, it's actually similar, $3.15. Okay, tangible book value takes away anything that's non-tangible. Overall, you know, I think this is kind of fair, honestly. Like, for what we're getting, I say $3, around like $3.50, I would say would be considered like fair value. And of course, seeing that the current share price, it is $15.54, these ratios of price divided by book value and tangible book value are very, very high. 4.61 for the book value and almost 5 for the tangible book value. Guys, we want this thing to be as close to 1 as possible. And yeah, this is looking very, very expensive. Now, obviously, this does not take into account any assumptions. However, just because it doesn't use any assumptions doesn't necessarily mean that you guys shouldn't have these calculators. Please have them, because even though I do not like to buy into growth companies, because I just think that there's way too much risk, I'd rather buy like well-established companies at a really good valuation. That doesn't mean that you guys should follow that trend. Obviously, you guys do whatever you want. It's not financial advice. Every investment is the present value of all future cash flow. That's why I'm giving all of these out for free. Now, as I said, this is just my way of investing. I do not like to invest in growth-oriented companies because, well, the downside, the risks are way much higher than the rewards are. If you were to put in money into all the growth companies out there and 2 of them make it out, those 2 will probably not be able to subsidize the loss of all the other ones. So just be very, very mindful when you do that. My whole thing here on the channel, it is to minimize risk at all costs. And growth-oriented companies are not in that sense unless they are completely showing a massive difference when it comes to their actual fundamentals. Unlike this one that we're seeing negatives all over the place, that's just the reason why I'm looking at this. I'm like, does it have potential to grow? Yeah. Do I want to risk it? No. I work hard for my money and you guys work hard for your money. So again, this is the way I like to invest. You guys can, follow it, or if you guys still like this company, then by all means go ahead and, put your money wherever you would like. I'm just saying that me personally, for me, this kind of investment is way too risky. But please still have all of these calculators, guys, that are available for free, because I want to be able to provide as much value to everybody as possible. All we're asking for in return, guys, is just like, subscribe, comment. It really does help out with the algorithm on YouTube. Thank you so much for the help so far. We're almost up to what, 2,060 subscribers. Y'all are crazy. Absolutely, y'all are just crazy. So I have big plans. If you guys saw the live stream, I have big plans in the future. Hopefully I'm able to do them, if the opportunity presents itself, and I'm going to do everything in my power to make that opportunity actually happen. And the best way that you guys can give me the opportunity is just, of course, like, subscribe, comment. It really does help. Overall, when it comes to UiPath, my issue is just it's too new. We don't have 5 years of data, and I would like to see, I don't know, I would just like to see more positive numbers before putting money into a company like this, right? I at least need to see a trend upward. Right now, the trend is just all over the place. So unless I see that, I probably will not invest into this. But of course, that's just my personal opinion. You guys can do whatever you want with your money. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the new tech sites. Link in the description below. So with that said, peace out, and I'll see you all in the next stock analysis video.